To attest to information means to provide assurance as to its reliability. In an attest engagement, the CPA is engaged to issue or does issue an examination, a review, or an agreed-upon procedure report on subject matter or an assertion about subject matter that is the responsibility of another party, such as management. Note the three types of attest engagements: examination, review, and agreed-upon procedures. The most common is the audit of the financial statements. This is an examination. 90% of this course covers the audit of the financial statements. The last couple of chapters will cover reviews, agreed-upon procedures, and some other issues. Notice the examination, the audit, provides a high level. In our audit literature, we actually use the term reasonable level of assurance. Also note that we want to keep risk at a low level. Again, the auditing literature calls for audits to be designed with low risk in mind. The review procedures require moderate. Limited is more often pointed to risk. Audits contain numerous audit procedures. Reviews are generally limited to inquiry and analytical review. Agreed-upon procedures are simply procedures agreed to by the auditor and the client. Auditors gather evidence and provide a high level of assurance that the financial statements follow generally accepted accounting principles. The audit involves searching and verifying accounting records and examining other documents. An appropriate amount and nature of evidence is gathered in order to form an opinion that is issued in the audit report. Evidence must be sufficient and appropriate. More on that in later chapters. The audit covers the balance sheet and related statements of income, retained earnings, and cash flow. It covers all four statements. The goal of the audit is to determine if the financial statements are prepared in conformity with GAAP. Don't forget that management is responsible for preparing the financial statements that are in accordance with GAAP. The American Institute of Certified Public Accountants sets the audit standards for the audit of non-public, also known as non-issuer, companies. The American Institute of Certified Public Accountants is the national professional organization of CPAs in the United States, with over 400,000 members in 143 countries. The Public Company Accounting Oversight Board is a U.S. government agency that sets the audit standards for the audit of public, also known as issuer, companies. It was created by the Sarbanes-Oxley Act of 2002. That act was created in response to a loss of confidence caused by several big accounting frauds, most notably Enron. The Financial Accounting Standards Board is a private, nonprofit organization standard-setting body whose primary purpose is to set generally accepted accounting principles for entities other than federal, state, and local governments. The Securities and Exchange Commission has designated the FASB as the organization responsible for setting accounting standards for public companies in the U.S. The Government Accounting Standards Board sets generally accepted accounting principles, GAAP, for federal, state, and local governments. The Securities and Exchange Commission is a U.S. government agency. The SEC holds primary responsibility for enforcing the federal securities laws, proposing security rules, and regulating the securities industry. Each state has a state board of accountancy that license CPAs. Most have reciprocal agreements for practicing within the state. All boards require successful completion of the CPA exam. Education and experience requirements varies by state, but most require 150 credit hours of college education, not a master's degree. It's 150 credit hours of college education. NASBA is the National Association of State Boards of Accounting. Go to their website at nasba.org for information about each individual state's CPA requirements. Check them out at nasba.org.